How's it going, everyone? My name is Dan, but you can call me Malone. And if you didn't hear, on Wednesday just gone, US Federal Reserve Chairman Jerome Powell indicated that interest rates could soon be rising. Now, my last video covering the stock market super bubble, we briefly touched on this topic. So in this video, I'm going to discuss in detail why interest rates are rising, the consequences of rising rates, and whether or not you should be concerned. But before we begin, if I could ask that you take 2 seconds out of your day to leave a like on the video, and if you're new around here, don't forget to subscribe. So it's important you understand what the role of the Fed actually is. The Fed is the central bank of America. Similar to the European system of central banks, its primary purpose is to maintain price stability in the economy. Price stability is measured by inflation. Inflation is the increase in the price of goods and services in the economy. Now, both the Fed and the European Central Bank believe that an inflation rate of 2% or below is indicative of price stability. If you've too much inflation, the average household falls under pressure because of the rising cost of living. But if you've too little inflation, that can be a sign of slow economic growth. So the balance needs to be just right. In order to strike that balance, central banks have control over what's known as monetary policy. Monetary policy includes the control of interest rates. Now, if the central bank wanted to reduce inflationary pressure in the economy, they would increase interest rates. Rising rates makes borrowing money more expensive, therefore reducing the amount of money available to buy goods and services. We'll touch on that more a little later. If, on the other hand, the central bank wanted to stimulate the economy and the demand for goods and services, they would lower interest rates. Falling rates makes borrowing money cheaper, therefore increasing the amount of money available to buy goods and services. So why is Jerome Powell and the Fed planning on increasing interest rates in March this year? To understand this, we need to travel back in time to March 2020. When the pandemic broke out and the markets collapsed, the central banks of both America and Europe stepped in to save the day. Their priority was to make sure that the flow of money in the economy continued to circulate amidst the uncertainty of the pandemic. The last thing they wanted was for the money supply to dry up and cause an economic crash. They achieved this by reducing interest rates to near zero and by using an unconventional monetary policy tool known as quantitative easing. Quantitative easing, or QE for short, is when central banks buy financial assets like government bonds, corporate bonds, and even stocks. Here's how it works. Central banks have the ability to print money out of thin air. When a QE strategy is implemented, the central bank uses this new money to purchase financial assets like bonds. Bonds are issued by governments and companies as a way of raising money, and when you buy a bond, you receive an interest payment in return for your investment. So therefore, when the central bank buys government or corporate bonds, they're effectively injecting these institutions with money. With the central bank buying billions of dollars and euros worth of bonds, this caused the price of bonds to increase. Remember, buying a fixed rate bond will entitle you to a predetermined interest rate as a reward. As the price of a bond increases, the yield you receive from the bond will decrease because you're paying a higher price to receive the same fixed amount of interest. As yields fall, the cost of borrowing money decreases, making it more likely that businesses and individuals will take out loans and increase their spending. The stock market is positively impacted by quantitative easing, as we've clearly seen with the price acceleration of the S&P 500 and the NASDAQ since March 2020. The explanation for this is quite simple. Because the Fed kept interest rates at near zero and was buying bonds aggressively, the returns offered to investors by these bonds was abysmal. Naturally, investors turned to the stock market in order to earn better returns. As the Fed continued to buy bonds, more and more investors flocked to the stock market, causing what many analysts now believe to be a bubble. But the Fed had achieved its goal. People were spending money, unemployment was decreasing, and confidence was restored. You might be wondering how much the Fed actually bought. Well, between March 2020 and January 2022, over $4 trillion worth of financial assets were purchased. Now, however, the Fed is in the process of its tapering program, which essentially just means they're reducing the amount of bonds and other financial assets that they're buying by about $30 billion each month. meaning in the coming months, the Fed will reduce its buying activity to zero. The reduction in Fed purchasing results in a decrease in the price of bonds, an increase in bond yields, and ultimately a reduction in the price of stocks. So with that understanding, we can answer the question of why interest rates are being increased. Because global central banks have injected trillions into the economy, the demand for goods and services has increased. But we're in a very unique situation because our global supply chains are still crippled from the effects of the pandemic. Because of this, we've lots of demand for goods and services without the supply to match that demand. This has caused what's known as demand pull inflation. Too many dollars chasing too few goods. Because there isn't enough supply to match demand, prices increase and the purchasing power of our cash decreases. Oftentimes, wages increase in order to offset the effects of rising prices. Jerome Powell notes that this is happening in the US and it's a cause for concern. Increasing wages to offset inflation results in higher business costs. These costs might be passed on to the customer by increasing prices even further. This causes a feedback loop of continuous inflation. As well as this, inflation can be self-fulfilling in the sense that if customers are expecting prices to increase in the future, they'll buy more today, which will naturally increase prices. This very much has the potential to get out of control, and we're already seeing record levels of inflation across the globe. And as we mentioned at the beginning of the video, if central banks want to reduce the inflationary pressure on the economy, they will increase interest rates. Hence why the Fed announced potential interest rate hikes on Wednesday. So what are the consequences of these increases and should you be worried? First off, the Fed is a separate entity to the European Central Bank. So what's happening in the States won't necessarily happen in the EU. Because interest rates are increasing, it's going to become more expensive to borrow money. Lending institutions such as banks use benchmarks like the Federal Funds Effective Rate and the Euribor to determine the interest rates that the borrower pays on their loans. Naturally, as the benchmarks increase, so too will the interest rates charged on loans. In the short term, we'll likely see an increase in personal loan interest rates and interest rates charged on credit cards. We're also starting to see an increase in mortgage interest rates, which in the context of the global real estate market is bad news for buyers, as affordability continues to be a major issue. From an investment perspective, interest rate hikes could mean bad news for stocks. As interest rates rise, future company cash flows are discounted more heavily. This results in the price of stocks falling, unless the market increases its expectations for future cash flows, which may or may not be feasible. This is particularly worrisome for riskier stocks, whose future cash flows might be subject to significant uncertainty. That might explain why 33% of stocks listed on the NASDAQ are down more than 50% from their one-year highs. There's no right answer as to how you should or shouldn't react to this news. Inflation is becoming a major problem. There's no doubt about it. While the OECD is forecasting a slowdown in the growth rate of inflation later this year, it still remains well above pre-pandemic levels. So action needs to be taken by global central banks in order to curb inflation growth. One of their principal objectives, as we mentioned, is maintaining price stability. So if they didn't increase rates, they would ultimately be failing that objective. In my opinion, most investors will be served well by blocking out the noise of the media and avoiding making any rash decisions on the basis of emotion, fear, or uncertainty. What we're seeing in front of us is the ebb and flow of the financial markets. However, the level of uncertainty and fear you feel is likely a direct reflection of how solid your investment rationale was in the first place. If you make decisions based on emotion, the consequences of those decisions will come back to haunt you in the form of uncertainty when times are bad. Hence why personal finance is personal. What you do, or more importantly, what you don't do, needs to be considered in the context of your own personal circumstances. Let me know what your thoughts are on the current economic situation and the rising rates and what your strategy is going forward. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.